Hello, students. Let us continue with a new chapter. The name of the chapter is Change in Profit Sharing Ratio Among Partners, which means the existing partners. So, this happens at times in a business when a business is functioning, the partnership business, while it is functioning, there could be a situation that partners want to change their profit sharing ratio. So, in such situations, what happens in the partnership business? We will see in this chapter. So, in any situation when there is a change in the profit sharing ratio, we must remember this is known as a reconstitution of a partnership. This is known as a reconstitution of a partnership. So, this happens when there is a change in the profit sharing ratio among partners. Now, what could be the reason for change in the profit sharing ratio? We will discuss. So, the first point or the reasons for such a change. So, a few reasons we will see. The first of them is maybe partners want to themselves change the existing ratio. So, at times, partners within this partnership business can say that they want to change their ratio, they want a different profit amount. That means they want to change the amounts which are given to each of the partners. So in that case, for example, it could be there are three partners, A, B, and C. Their ratio is 2 is to 1 is to 1, and they change it to be something new. The new ratio being, let's say, 3 is to 1 is to 1. This is their old ratio. And they convert it into a new ratio, which is 3 is to 1 is to 1. So this could be one reason. The second reason could be on admission of a new partner. So this we will see in the following chapter, which comes after this. So what happens in this case? Let's briefly discuss it. Let's say there are two partners, A and B. A is to B, and their profit sharing ratio is 2 is to 1. Let's say they admit a new partner, C. Now, C is a new partner, and when he comes, let's say the new ratio becomes 2 is to 1 is to 1. So, what is basically happening? Let's try and understand this diagrammatically. Earlier, in this case, let's say this is the total profit which we consider. And since there are two partners and they are getting a ratio of 2 is to 1, this means A is getting two parts and B is getting one part. Now, in this case, in the second case, when C is admitted, what is happening here is the ratio is changed, but the amount of profit will be the same. Let's say the amount of profits are the same. We are assuming that these profits are the same. That's why I'm making it almost the same dimension. So in this case, if I'm saying A is getting two parts, B is getting one part, and C is getting one part, this is what this means. And diagrammatically, you can see that A's share is probably become lesser. You see, A is getting lesser. You see the size of what A is getting? It's just this much compared to the earlier, which was so much. So this has become less. Okay. What is B getting? B is also getting less. So B's share is also reduced compared to his earlier share of what he was getting. And C is a new partner. C is in fact not there in the picture before this situation. He's just come in this picture. So here his share is something that he's going to get this time. Okay. So this is another case where we are saying the profit sharing ratio changes where one partner is coming into existence. Another case on retirement or death of a partner. So what happens on the retirement or death of a partner? Let's take the previous example. Let's say there were two partners, A and B. Their share was 2:1. This is their old ratio. Now, if I draw it diagrammatically, the same way, I take the same sized square. So this is A, and this is B. He's getting two parts and B is getting one part. Now let's say one of them expires. Let's say A expires. So if A expires, or he retires, what would be the size of the profit? Size of the profit would still remain the same. Okay. And if we consider it like this was the size of A's profits, these two, and this was B's. Now, in this case, all the profit is going to be for B. So this will also get back to become B's share. Okay, so I've considered it with two people. We may take with more people, which we'll see in that chapter later on when we come into this topic. The fourth situation could be when two firms unite. So, which is called on amalgamation of two partnership firms. So let's say there are two firms which have two partners each. A and B are of one firm. Their profit sharing ratio is 1:2. And there is a second firm which is X is to Y, where they are getting profits of 3:1. This is the first firm. So when these two amalgamate, when they two become one, when they join hands in order to form one partnership firm, at that point in time, they can say they decide that the new ratio would be A is to B is to X is to Y, which is 1:2 is to 3:1. So this could be their decision. So these are four situations where we can say the profit sharing ratio of the partners have changed, and this is said to be that the firm has been reconstituted. We have written it down here. We have said that this is going to be known as reconstitution of the partnership firm. or the partnership business. Okay. Now, there are reasons for what will take place now. In this case, when the partnership firms, partners change their profit sharing ratio, there will be some things which we will have to calculate. Okay, so first thing which we will decide to calculate is calculation of sacrificing partner, or you can say gaining partner, and the new ratio. Okay, so we'll take this topic. We will do a few questions on understanding what is happening in this case. So let's look at question 1.A. It says X and Y were partners in a firm sharing profits in the ratio of 5:3. So X is to Y are two partners. The ratio is said to be 5:3. Then it says, with effect from the 1st of April 23, they agree to share profits equally. So their new profit sharing ratio. This is their old ratio. And the new ratio now is 1:1. Calculate the individual partner's gain or sacrifice due to the change in the ratio. So whenever we have to find whether somebody is gaining anything or somebody is sacrificing anything, we will do it by subtracting the new from the old. So we will do old share, minus the new share. And this will either give us a sacrifice or a gain. So let's understand. We are writing for two people who are X and Y. So for X, what is their old share? For X's old share is 5/8. The share which he has, which is 5, and the total share, which is 8. So 5/8. And for Y, his old share is 3/8. From this, we are going to subtract the new share. The new share is 1 upon the total, which is 2, and again 1 upon the total, which is 2. So let's see what this comes out as. So here I will take 8 as the denominator. So it will be 5 minus 4, which is 1/8. In the second case, it is again 8 in the denominator. I will do 3 minus 2 fours are 8, so 1 fours are 4, which is minus 1/8. Now in this case, you can see that X in this case, his earlier portion was more. That is why when we subtract something from it, we are subtracting something from the earlier portion, and it is coming as positive. So we will take an assumption that whenever we subtract and we get a positive answer, we will call this as a sacrifice done by that person. So here I'm going to write, this is the sacrificing partner. And whenever we get a negative answer, this we will say as a gaining partner. Okay, so let's write the answer. It is asking us who is the sacrificing and who is the gaining, I suppose. So it is asking calculate the individual partner's gain and sacrifice due to this change in the ratio. So partner X has sacrificed 1/8 share, and partner Y has gained 1/8 share. Okay. So what is one partner's sacrifice at the same time will be another partner's gain, which is proved by this. So that must be our answer also. Yes, X is sacrificed and Y gains 1/8 of the share. Let's go to the next. So let's come to the second question. It says A, B, and C were in partnership sharing profits in the ratio of 4:3:1. Question 2.A. So A is to B is to C is 4:3:1. Then it says that the partners agreed to share future profits in the ratio 5:4:3. So the new ratio A is to B is to C 5:4:3. This is the new ratio. This was the old ratio. The question is saying calculate each partner's gain or sacrifice due to the change in the ratio. So we need to understand. Let's elaborate on this. These three are ratios. Okay, so when we talk of a ratio, there is a difference between the share and the ratio. What is mentioned on the screen right now is the ratio. So if I say A's old share, just like we calculated it some time back, we will just write that formula which we worked out. So it is old share minus new share equals sacrifice or gain. So we have three of them. So A, B, and C. So for A, what is his share? So his share is out of the total. So the total over here is 4 plus 3 plus 1, which is 8. So out of 8, A has 4 parts. You can understand it in that way. So 4 upon 8. Out of 8, B has 3 upon 8. Out of 8, C has 1 upon 8. Minus, minus, minus the new share. Now this total is 5 plus 4, 9 plus 3, 12. So out of 12, A has 5 upon 12. Out of that, B has 4 upon 12 and C has 3 upon 12. Again, let's do a calculation by taking a base. In this case, I'll take the LCM. So between 8 and 12, 4, 4 2s are 8, 4 3s are 12. So this LCM comes as 3 2s are 6, 6 4s are 24. 24. So 8 3s are 24, 4 3s are 12 minus 12 2s are 24, so 5 2s are 10, which is 2 upon 24. The second case, Again, my LCM would be 24. So 3 threes are 9 minus 12 twos are, so 4 twos are 8, which makes it 1 upon 24. The third case. Again, my base comes out as 24. So 3 minus 3 twos are 6. So which is minus 3 upon 24. So here, looking at this, what we have just worked out, we can say that A is the sacrificing partner, B is the sacrificing partner, C is the gaining partner. Okay. And if you see 2 upon 24 plus 1 upon 24, it comes out as 3 upon 24. So A and B have sacrificed. And that same amount of gain C has got, which is again 3 upon 24. So any two partners sacrifice equals the third partner's gain. So the question asked is how much is the gain and the sacrifice? So we will say A is sacrificed 2 by 24, B sacrificed 1 by 24, and C gains 3 by 24. Okay. All right. Now let's talk about another concept now, which is goodwill. Okay. Just before we conclude this topic, we must understand why do we change the profit sharing ratio. So we saw some reasons in the past. We said when partners decide. Okay, so we'll talk about that first reason. We're talking about when partners decide among themselves that they should change it. Profit sharing ratio. So why is it so? So it could be that maybe a partner is going to bring in more capital. So if one partner brings in more capital, let's say there is one partner among the three. There are three partners, A, B, and C. And among them, A says, I'm going to bring more capital. There are some partners, A, B, and C, and A says, I'm going to bring more capital. So if he brings in more capital, definitely he would want more share of profit. So that is one of the reasons why this calculation is done, or we are going to now study this chapter. This is one of the reasons. After this, we'll talk about a topic which is goodwill. So, what is goodwill? Goodwill, as the name suggests, it's something that is good for your company. So it is the reputation of a business. Okay. So the reputation of a business, and it means that we can classify this reputation or this goodwill into two ways of calculating. Or basically, what I mean to say is goodwill is divided into two types. So the first of them is called purchased goodwill. Purchased goodwill. That means, let's say there are partners and they are purchasing a different kind of a business. Now, in this purchase of this business, they have to pay for the goodwill of that business also. It's not only of the assets that they will pay the amount, it's not of the liabilities that they will pay the amount, it is of the goodwill as well of that company which is already existing. So purchase goodwill. The first point which we can write about this is it's going to be recorded in the books. So the value of purchase goodwill is going to be recorded in the books of accounts. Now, when I say it is going to be recorded in the books, it is going to be recorded in the books as an asset. Okay. Another feature of this is it is going to be amortized at the earliest. It is going to be amortized at the earliest within the economic life of the asset. Okay. This goodwill arises on the purchase of an asset. Okay. This goodwill arises on the purchase of an asset. So these are key features of this kind of a goodwill. Okay. And formula wise, if we write this is going to be goodwill equals the purchase consideration minus the net assets. Okay, so formula wise also we have the value which we are going to write in the asset side of a balance sheet by calculating this. So we are going to calculate this by subtracting our net assets from the purchase consideration. So we'll understand this with a question. Before that, since we just started this topic, first let's also write some features of goodwill. We know what goodwill is, the reputation of a business. In short, now some features of goodwill. The first feature of goodwill is it is an intangible asset. Okay. So goodwill is an intangible asset. Example of an intangible asset is patent, copyright, etc. It is not depreciable, although although its value may keep fluctuating. Okay. How will its value fluctuate? Example, in case of losses to a business, you're really talking about a partner business, the goodwill goes down. And in of super profits, in case of super profits, the value of goodwill increases. The next point, goodwill of a business will never be sold in part. The entire goodwill will be sold when the business gets totally sold. So this is meaning that at any point in time, you cannot say that you buy half of my business is goodwill. You cannot sell half of your business is goodwill. It's always found out at the time of winding up. And at that point in time, when you're selling this business, you're going to charge for the entire goodwill of that business. You cannot sell hidden parts. Okay. Now, what's the nature of goodwill? We saw that this is an intangible asset. So, if you're asked what is the nature of goodwill, you would say it is an intangible asset, but not a fictitious asset. Okay, so it's not a fictitious asset, it's something which is actually existing. A fictitious means something which is imaginary. So it's not an imaginary asset, it's actually there and it is measurable in terms of money. It has a value because goodwill, unlike fictitious assets, has a value. Okay. After this, what are some factors that affect goodwill? So, how will a business get affected in terms of goodwill by certain factors? So what are those factors which affect the goodwill of a business? That's what we are talking about. So the first factor will be maybe quality of the product. You have very good quality products. Quality is very good, top notch. This would imply goodwill would also be good. It would be high. You can charge a higher value for your goodwill. The management of the business. So let's say the management is top notch in this business, which will also imply goodwill is top notch. If the management is poor, my goodwill of my business will also be less. The location of the business, where my business is located, where my factory is located. Let's say it is located in Mumbai. So the location is top notch, which implies my goodwill or my impression of my business will be good in the eyes of the consumers. So my goodwill will also be better. Let's say licenses obtained by the business. So if I have been able to obtain licenses, my goodwill will be more because it is not easy for every person to get a license in our country, especially. You have to do a lot of hard work to get such licenses to do such businesses, which require licenses. So having a license would put your business apart and it would give a good impression to the consumers. Then capital, another important factor. The more the capital is more, it implies I will have a higher goodwill because people think the more the money invested by the proprietor in the business, that business would be doing well, or that business has sufficient amount of money to carry itself on. So this is another factor. So these are few factors which we can keep in mind when we are considering the goodwill of a business. Before we go on to the second category of goodwill, we'll just do a question. So let's open that question in the book, which is on the goodwill which is written down in the books. So that is why we are calculating it. So let's do question 3. It says, Madhu, just read through the question. Okay. It says Madhur and Company acquired a business of Vishu for a purchase consideration of 11 lakh, which was paid by check. The assets and liabilities taken over were as follows. Now you have two kinds of values, the book value and the agreed value. We always have to consider the agreed values. So here we have been told assets and some liabilities, and we have been told a purchase consideration. So let's calculate our total assets. Remember what I got you to write? Goodwill is purchase consideration minus the net assets. So for our net assets, this is question 3. Our net assets equals furniture plus debtors. Okay, furniture plus debtors. Now, these debtors will be our net debtors because over here we have been told we have been having to give a provision. So, debtors minus provision. Then plus the stock minus now our liabilities, which are bank overdraft and creditors. So which is equal to 40,000 plus our debtors, which is 250, and 4% is the, so the amount will be on 250 or 250 minus 4% of 250. So 250 into 4 divided by 100, which is 10,000. So 250 minus 10 plus the stock, which is 720. Then minus 20 and minus 180. So this comes out as 40,000 plus 240 plus 720 minus 2 lakh, which is 8 lakh. So net assets are 8 lakh. Now, the goodwill equals a purchase consideration minus our net assets. So which is 11 lakh minus 8 lakh, which is 3 lakh. So 3 lakh is a goodwill. Let's check our answer. 3 lakh is a goodwill. Question is saying ascertain the value of goodwill and pass the necessary journal entries. So let's try and understand what is happening in this question. We have a business which we uh, are saying Madhur and company acquired the business of Vishu. So whenever you acquire a business, what happens in this situation is you purchase the assets. So what are the assets? The first is furniture, debtors, stock, and then you also purchase, in addition to that, your the person who's selling you the business, his liabilities. So bank overdraft was there, creditors were there. So when you purchase everything in the business, over and above this, you're going to pay an amount which is going to be more than the net assets. Your net assets in this case, which we just saw, was 8 lakh. So 8 lakh was found by calculating what? We added our assets and from then we subtracted our liabilities. So this was the amount which was supposed to be paid. And but we are not paying that much. We are paying something more than that. If we were only to pay that much, we would only have to pay 8 lakh. But we are paying 11 lakh. So what is this 11 lakh? This 11 lakh is including some amount which is called goodwill notes. So that amount is calculated by subtracting from the purchase consideration your net assets, which gives you an amount of 3 lakh. So 3 lakh is your goodwill. Now, the entry which you have to pass in this case, the first entry will be all your assets. So the first asset you purchased were furniture and then debtors. So my first entry, furniture account, debit, debtors account, debit, and one more was the stock account, debit. Then two, we had some creditors, so creditors account and bank overdraft. So what did we pay? What we paid was the purchase consideration. So who did we pay this to? We paid it to a person who was, in our question, Vishnu. But who has purchased this? So Madhur and company acquired a business of Vishnu for a purchase consideration of this. I check. So we will write Vishnu in this case. Okay. So because you're buying it from this person. So to Vishnu, and here you're paying 11 lakh. Bank overdraft, we saw it was 20 and creditors 180. Then furniture 40. Debtors 250 minus 10, which is 240. Then stock is 720. Now What is the difference here? Let's see. So 11 plus 2 minus 720 minus 240 plus, no, minus 40. Minus 40, not 4 lakh. So minus 40 makes it 3 lakh here. So this balance will be known as goodwill. Again, goodwill is an asset, which I said you're going to write it in your books. So you're writing it down. This is your balancing figure. Amount is 3 lakh, which is also what you just calculated on top. So here the narration will be being business purchased. The second entry. Now when this money is going to be paid. So the entry would be Vishnu debit. The amount would be 11 lakh to, it would be bank account. Amount would also be 11 lakh because you're paying this much amount. Narration being purchase consideration paid because you're paying it. Okay. So this is the first goodwill that we spoke of, which is called purchase goodwill, which is calculated in this way, which we write in our books and show it in this way. Again, this will be shown as an asset in a balance sheet. Now, the second type of goodwill, this is called self-generated. So, what is this kind of goodwill? This is that kind of goodwill which is generated once the business is forming its own image. Okay. The goodwill generated by a business itself from the start when it is forming is called self-generated goodwill. So some features of this. This is self-generated by a business on its formation, or you can say after its formation. Another one, its value depends on the subjective judgment of the valuer. Okay, so this kind of a goodwill depends on this judgment of the valuer. Whoever is judging this, let's say they make a new company XYZ, and they say the goodwill is worth 50,000. So this judgment is based on the value that they have given. The next, as per accounting standard 26, this goodwill is not recorded in the books. Okay, because a consideration in cash has not been paid. So this kind of a goodwill is not paid up in cash. So definitely we are not going to write this in our books of accounts. Okay. So these are basically the introduction of this chapter. We are talking, or we've spoken about what happens when the profit sharing ratio changes. We said that a new ratio is found on admission, on retirement, or death, or when two firms amalgamate. Then we saw about the sacrificing, the gaining ratio, and the new ratio. We also saw something about goodwill. We saw two types of goodwill. The first was purchase goodwill, which we said is recorded in the books, which we calculated with a formula, which is purchase consideration minus the net assets. In this case, purchase consideration was the amount paid on purchasing a new or existing business. Okay. Then we wrote down some features of goodwill. We saw it as an intangible asset. It is not depreciable, although its value keeps on fluctuating. We saw goodwill will never be sold in parts. If we sell it at the time of closing down the business, and it's totally sold at that time. We saw the nature of goodwill. We said it is an intangible asset, although it is not a fictitious asset because goodwill has a value of its own, unlike fictitious assets, which are imaginary. And we saw factors affecting goodwill. We saw the quality, the management, the location of the business, licenses, or capital, which is already there with the business, affect the value of goodwill. We solved a question in order to find out what is the way we get our goodwill, and which is recorded in our books, which is called purchase goodwill. We wrote down the journal entries for them. And then we did the last of them. We saw self-generated goodwill, which we said this type of goodwill is formed by a business after its formation. Its value depends on the judgment of the valuer. And as per AS 26, Accounting Standard 26, this goodwill is not recorded in the books because the consideration in cash has not been paid. So we'll stop here. We'll continue with the next topic, which will be about valuing our goodwill and the ways of calculating our goodwill. If you do like this video, do share it, do like it, and do subscribe. Thank you.